It's the market makers. It's some people might think the most important part of the market. What should we expect from this episode?
Yeah, so this is really, we're focusing on the guys who trade options from a volatility perspective, right? So not the punters, not the people who've got necessarily that strong a directional view on the asset, but the people who provide liquidity to everyone else, and they hedge the options and they turn them into a volatility position.
And they say volatility because that's going to be one of the most important things we talk about. But volatility in option, movement in a stock, what's that relationship? Because what does that all mean?
So in the simplest terms, if volatility is just how much the asset moves or is expected to move, okay? Historic or realized volatility is how much it has been moving. Implied volatility is how much we think it's going to move. And in terms of what that actual number represents, if we expect a 1% per day move in the asset, then that equates to a 16% annualized vol, because it doesn't mean there might be 252 business days in a year. Just because it moves 1% a day, we don't think it's going to move 250% a year. We think it's going to move 16% a year because there's a square root function because of the way the maths works out, which we don't need to go into. But that rule of 16 is key because that means we can, anytime we see a volatility number, an annualized volatility number of 16, that means 1% a day expectation. And if it was 32, for example, it would mean a 2% a day.
48.3?
Exactly.
I'm getting there. Okay, so let's get into those Greeks then.
Let's do it. In this module, we will be looking at the market makers. Without these guys, there would be no options market. These are the players that provide the liquidity that allows most other participants to trade. They can make money even if you are also making money, because this is not a zero-sum game. But how do they do it and what do they do? Well, they focus on taking small margins from a large number of trades. And to do this, they break down the price of an option into its component parts, which are called the Greeks: delta, gamma, theta, and vega. Market makers do their best to neutralize these exposures to the various Greeks throughout the day as they face off against the various buyers and sellers of options in the market across all kinds of strikes and maturities. Ideally, a market maker wants to stay flat and just capture bid-offer spread by providing liquidity. Some of the biggest names in the US listed options market include Citadel Securities, Jump Trading, and Susquehanna. These sophisticated firms use automated high-frequency systems to lay off risk quickly and efficiently across all trading venues available. They are able to shift their prices quickly across securities in response to trade flows and/or market moves. Their trade holding periods will typically be much shorter than the average investor because they don't enter trades out of desire. They get put into positions and then they try to manage that risk or get the other side as quickly as possible to retain some of the spread as margin. Their advanced modeling of volatility behavior in markets gives them an edge in predicting how options prices will behave so that they can best manage their risk and come out with a profit over the course of many trades. The Greeks are often considered to be the scariest part of options trading. But by looking at it through the lens of a market maker, we see how important they are and can gain a better insight into how options behave. So what are the Greeks? I'm sure you've heard the term before, but what do they actually mean? Essentially, they just tell you how an option's price will be impacted by changes in the various parameters, such as the spot price, the time to maturity, and the implied volatility. For example, an option's price could easily double overnight, but how much of that was due to a move in the stock's price, or was it due to moves in volatility? That is what the Greeks allow you to see and potentially predict ahead of time. Now, whilst differential equations and calculus might be fun for the maths geeks out there, for most everyday people, the concept of options Greeks and high-level mathematical formulae make them run a mile. And the reason is that it can be quite intimidating for someone who isn't a maths major when they come across derivatives terms like these. Okay, that's enough of the equations for now. But we can't get away from these terms. They are integral to what the market maker does, and therefore integral to the overall options market and how it all fits together. But my goal in this video is to make the Greeks more intuitive and accessible. And to do that, I will use an analogy that we can all relate to, which is driving a car. So how are we going to simplify the Greeks? The first Greek we will look at is delta. Market makers are nearly always delta hedging their options. That means they are buying and selling options and then buying or selling the offsetting position in the underlying stock or asset so that they are market neutral, meaning that they are hoping not to win or lose too much on the actual stock price movement. This frees them up to focus on making money on the other aspects of the option price. Though in fact, trading in and out of their delta hedge is still one of the main ways that they generate income from a position. So delta, this is the change in an option's value for changes in the underlying price of the asset. In terms of the car analogy, we can think of delta as the speed of a car. If you were just long a stock, then when the stock goes up by $1, you make $1 of unrealized profit. We can think of this as being the only speed of the car, the maximum speed. We can call a long stock position a 100% delta position because its profit or loss, P&L for short, moves exactly in line with the movement in the stock price. But when it comes to an option, the price of the option can have a variable relationship with the price of the underlying asset. The option price can capture all, some, or none of the underlying move. Let's now think about this relationship from the perspective of a call option, or a call for short. You may recall from the opening episode that the owner of a call option has the right, but not the obligation, to buy the underlying asset. If we bought a call option with a strike that is out of the money, say $110, and expiring in a week, with the stock trading at $100, the probability of that call option ever getting in the money and being exercised is quite low. The stock would need to go up over $10 or more than 10% in 1 week to be in the money. In the money is where the price of the stock is above the strike of the call option. If the stock goes up by $1 in the first couple of days to 101, then the chances of this stock exceeding the strike price in a few days is still pretty low. And so the option's value doesn't move much. It is said to have close to zero delta, i.e. the price of the option changes very little, if at all, based on the $1 move in the underlying stock. Using our analogy, in this case, the car is not moving yet. If the stock continues to rise in this time period before expiry, the chances of getting in the money, where the stock price is above the strike of the option, also rises. And so the delta, or the speed, increases. Once the stock has risen enough and the call option is now at the money, where the stock price is at the strike of 110, the delta will have grown from near zero to 50%. An option with a 50 delta means that for a $1 rise in the stock, the option now increases in value by 50 cents. That is, the option price now captures 50% of the price move in the underlying stock, hence the 50% delta. If the stock goes well above the strike before its expiry, say to $150, and the option becomes deeply in the money, then the option price will now be capturing close to 100% of the price move in the underlying stock. For instance, another $10 gain in the underlying stock should increase the value of the option by also $10. The chances that we'll want to take delivery of the stock or exercise it at expiry will be close to 100%. And so the delta has also become 100%. The option is now said to be behaving like the stock. If the stock is at $150 and I have the right via my call option to buy the stock at $110, we know that I will almost certainly be exercising my right to buy the stock. We have essentially hit our max speed, where the option and the stock look the same in terms of delta exposure. The P&L now behaves like this. So you can see from this car analogy that call options that are out the money start off with little exposure to the underlying stock. But as we get closer to that strike price, the exposure accelerates to around 50%, where the option is participating in 50% of the move in the stock price. And finally, if the option becomes in the money, its exposure matches the stock at 100%. And so the option's price moves by the same amount as the stock price. This is said to be a positive relationship or positive delta. The price of the call option goes up when the price of the underlying stock goes up. This positive relationship exists because we have been talking about a call option, which is in contrast to the relationship between the price of a put option and the underlying asset, which we'll come on to shortly. The relationship between the stock price and the call price also works in reverse, whereby if you own a high delta call option, then it will lose a large amount of value if the stock price drops. So to take the last example, if the stock is at $150 and I own the 110 strike call, and the stock now starts to fall in price, the delta will drop from around 100% to around 50% if the stock declines to 110. A further decline in the share price before expiry will see the delta drop below 50% and potentially even go back to zero. My call option position would initially lose $1 for every dollar drop in the underlying stock, eventually losing 50 cents in value for every dollar in the underlying as it passes back through strike, until it loses zero for each dollar drop in the stock price once the premium has already reached zero and the option is well out of the money again. The option will reduce its exposure as the stock falls, and the option will lose value, but this is almost like hitting the brakes in the car. The losses on the long call option will be limited as its delta heads back down and the option value falls back towards zero. However, a long stock position would keep losing money on the way down, whilst the maximum loss on the option is the price that you initially paid for it, which is the premium. For the market maker who wants to remain delta neutral, they would need to trade stock or futures to hedge the option's delta. This hedge would need to be constantly rebalanced as the market moves and the option delta changes. Trading in and out of the stock hedge and adjusting how quickly they do it will be a major determinant of the market maker's P&L. Remember, they can make money by being market neutral, even when you are making money by taking a directional view. So far, we have described call options for the car analogy, but put options, or puts for short, work the same way, just in reverse. You may recall that owning a put gives the buyer of that option the right, but not the obligation, to sell the underlying asset at the strike price of the option. The stock price must therefore fall for a long put position to increase in value. Hence, the delta is negative. The relationship is the opposite to a call option. Calls go up in value as the stock price rises and fall in value as the stock price falls. Puts, on the other hand, go down in value as the stock price rises and rise in value as the stock price falls. So hopefully the idea of delta relating to speed and the direction of travel is starting to make sense. I will talk more about it with Roger in the discussion part of this module. Now that we have shown you how the delta, or the speed of the car, is changing depending on how close or far we get from the strike price throughout the life of the option, it's time to talk about gamma, which is how we quantify that change. As we saw a few minutes ago, the magnitude of change in the option price can vary wildly, depending on where the price of the underlying asset is versus the strike price of the option. This is not a static variable. Gamma is the change in the option's delta, which we've just described for changes in the underlying asset. And we know that this gamma changes as the stock price moves. In our car example, we can think of this as acceleration. When we are far from the option strike, the acceleration is low. In our example, the stock could be at $80 and the strike is at $110 with a week to go before the option expires. We should expect a low acceleration of option price versus underlying price, or a low gamma. But if we get closer to the 110 strike, the change in speed picks up for every small movement in stock price, and the delta, i.e. the price sensitivity of the option, accelerates more rapidly. In this example, the 110 strike is the point of maximum acceleration. When we are at the strike, and once we get beyond the strike and in the money, the acceleration starts to drop, even though the speed is still rising as we approach maximum delta of 100% when we are in the money. This option gamma is what gives options their asymmetry, because when a stock price is going the correct way for the buyer of the option, up for the call or down for the put, the option delta accelerates. But when the stock price goes the wrong way, the option hits the brakes and reduces its speed or delta. An option can often be dead in the water, and then boom, the underlying price heads to and through the strike, and the value of the option explodes higher. For market makers, the gamma is one of the main considerations that they have to worry about, especially into an option's expiry, because they may find themselves having to regularly buy and then sell stocks in order to remain delta neutral. And that costs money. You might have heard the term being short gamma, and that can be the worst nightmare for a market maker if the overall market starts to move dramatically around a major expiry. A market maker, or any trader and investor in general, is short gamma when they are short options, especially short dated and near the money options. The high sensitivity that these options have to changes in the price of the underlying asset creates massive swings in the market maker's delta exposure and forces them to hedge. The short gamma pushes their delta in the wrong direction, and so the delta hedges will tend to cost money as markets chop around, inflicting pain on the short gamma trader. Other investors who may be more flexible might be able to run their short gamma positions for longer and allow markets to mean revert, thereby not incurring the cost of constantly delta hedging. The main takeaway here is that the delta is the exposure an option has to stock price movement, and that is not constant, and it depends on the proximity to the option's strike. The closer the asset's price is to the strike, the larger the gamma, and hence the larger the change in that delta exposure for moves in the asset's price. When the stock price moves in the favorable direction for an option, its delta accelerates and increases to a maximum of 100% when the option is deep in the money. But remember, this price relationship also works in reverse. When the stock moves in the opposite direction for the option, its delta decelerates to a minimum of 0, and the profitable position can quickly evaporate and go back to 0. However, the total loss to the owner of the option is limited to the price or the premium that was originally paid. but the profit can theoretically be unlimited. And this is perhaps one of the most important concepts for the user of options. Let's remind ourselves, why do options have this asymmetry? It's because you pay a fixed premium to buy them. And that is the most you can lose. So whilst that all sounds quite exciting, let's now turn back to the reality and the potential for the gradual erosion of the value of an option through time. And that's because with an option, you are in reality buying time. Each option has a fixed lifetime, defined by its expiry or maturity date. For each day that you get closer to the expiry date, the premium you paid experiences time decay. So every day that passes by, an option loses some value. The Greek used to measure this is called theta. Going back to our car analogy, if the reason an option's delta, its speed, accelerates and decelerates is because of the gamma and the asymmetry of owning the option, then the cost of owning that option is the daily theta. And you could view this as your daily fuel cost for running this car. The more gamma or acceleration potential you have, the higher your daily fuel cost, your theta. You are burning fuel to have this car on the road when you buy an option. The more gamma you have, the more theta you will pay, all other things being equal. You must be aware that the option can lose value simply by time moving on, whether the underlying asset moves or not. Market makers hate losing on theta decay, just like you or I do. But at least they can make back some money by trading around their option positions and delta hedging. Theta decay, the cost of carry, can be a slow burning loss maker for all market participants. And let's not forget that the majority of options end up expiring worthless. Okay, so to recap, we have now covered delta, gamma, and theta. The last Greek I want to explain is vega. But before we do that, we need to understand the concept of implied volatility. Volatility, or the fluctuations in the price of an asset, is a concept that many people will be aware of. But here, we want to put it into the context of the Greeks. The implied volatility is the market's expectation of how much an asset will move in the future, and it directly impacts the price of an option. This is not the same as realized volatility, which is backward-looking and a measure of price movements in the past. If the implied volatility is high, then the option premium will be high, and therefore the daily theta, or potential for the value of the option to decline through time, will also be high. The premium of an out-of-the-money option that stays out of the money will eventually decay to zero through time. Whilst we said you could think of the theta as your cost of fuel per day to run the vehicle, the implied vol can be thought of as the unit price of that fuel. Options on assets with a high implied volatility should cost more than options on assets with a low implied volatility. If you bought an option on a stock that had a low implied vol, like a utility company that provides sewage disposal, then for a certain amount of gamma, you would have to pay a relatively low daily theta decay. That's because a low volatility stock is considered to have a smaller chance of its price suddenly surging through a given strike price. If you then bought an option with the same amount of gamma on a high vol stock, like a high-tech growth stock, the theta gas bill would be higher because the unit price of that gamma is higher. The market is expecting more movement from the high vol name, and so reflects that in the higher premium you must pay, and hence a higher rate of daily decay. Sticking with the vehicle analogy, it's like driving a tractor with cheap fuel, low vol, cheap decay, versus driving a rocket ship with expensive fuel, high vol, and expensive decay. Because the potential movement you will get from the rocket ship is far greater than what you would get from the tractor, you get charged accordingly in your price of fuel, your theta. That is how implied vol impacts the theta decay of an option. What if a low vol stock that was once perceived to be like a tractor and slow moving suddenly came alive and started moving around massively? The market perception would change and the stock would start to be priced more like a rocket ship because people would have realized that this stock is now having bigger moves. The options premiums will need to be higher to reflect that potential movement. Vega is your exposure to that change in perception. It is how much an option's value changes when implied vol changes. Once the market realizes that your once slow-moving option on a boring stock has now suddenly become valuable because the stock has started having bigger moves, you will make money through Vega, as the implied vol has moved higher and the options premium has gone higher with it. Basically, you bought something that was priced as boring that is now priced as exciting, and the premium should adjust higher to reflect that. One of the biggest fears for market makers is selling an option on a tractor and seeing it turn into a rocket ship before expiry. Market makers often have limited knowledge about the underlying stock and are pricing the option off the past price performance rather than a future projection on sentiment. Therefore, in summary, in this video, I have attempted to make the option Greeks feel more real. I've used the analogy of vehicles as something we can all relate to help understand these otherwise complex and abstract concepts. When we think of delta, we can think of speed. When we think of gamma, we're talking about acceleration. Theta as your daily fuel cost, implied volatility as the unit price of your fuel, and finally Vega as the exposure to your vehicle morphing into something faster or slower. Market makers are trying to manage all these risks when they enter into an options trade. Very rarely are they taking a purely directional view. If they sell you an option, it's not because they disagree with your view. It's because they think they can make money from some or all of these Greeks by the way they hedge and risk manage them. For directional traders, it's useful to understand these risks as it helps us understand some of the dynamics of individual options, as well as the movement of the broader market. Greeks are therefore the building blocks of the option price.